Hello, everyone. Welcome to our DAT IQ Weekly Market Update. This is our update for June the 4th, first one of June, and it's also episode 294. I'm Dean Croak, market analyst in here for Ken Adamo. He's traveling today. Also, a special guest, Ibrahim Bayan from Nuveen in Atlanta. Ibrahim, great to have you back as always.
I'm glad to be back, Dean. I know it's been a while, but I'm excited to talk a little bit about the trends I'm seeing on my end.
Yeah. For those that don't know you, tell us a little bit about yourself and what you do.
Sure. My name is Ibrahim Bayan. I'm the Director of Industrial Research for Nuveen, which is like an asset manager and investor in the commercial real estate space. And so my focus is mostly on industrial commercial real estate, so warehousing and logistics operations. I've been at Nuveen for about 2 years now. Before then, I did industrial research at CBRE. I spent some time at FreightWaves as the chief economist there, and I also spent about a decade at UPS as an economist there, just trying to understand package movements and things of that nature. So a lot of experience in the transportation and logistics industry.
Yeah, fantastic. I've learned so much from you about the trucking economy. So looking forward to bringing you back in a little bit later. We'll bring Ibrahim back in when we finish the forecasts, and we've got a very interesting discussion around the economics of trucking. So for those new to the show, we're here every week, 10 a.m. Eastern, 7 a.m. Pacific. Get your questions into the chat section. And with that, we'll get started on some of the key trends we're watching this week. Dry van spot rates up on a shortened and a higher end-of-month shipping week. Load post volumes are about 5% lower than last year. Equipment posts, though, are about 24% lower. It kind of highlights the exodus of carriers in the last year, plus the growing trend of carriers taking more time off around key public holidays, mainly because they can afford to. Active contract rates up slightly, but replacement rates based on RFPs recently conducted down 6% in dry van. The rate of carrier exits in May slowed after increasing in April. The number of carriers revoking their authority was down 3% month over month and about 18% year over year. The net change in capacity in this smaller section of the industry was about minus 601 carriers. ACT Research or ACT Research have a really good report out. Capacity and volume indices were both down in April. As Tim Denoyer wrote, evidence and anecdotes suggest that private fleets have taken some volume from the for-hire market as that sector adds capacity ahead of the 2027 pre-buy. And lastly, OPEC met on Saturday. Looking forward to John Kingston at FreightWaves writing about this. It was a pretty big meeting. OPEC agreed to extend production cuts through 2025 in an effort to bolster prices and avoid a global surplus of oil. Against the backdrop of rising production of non-OPEC members, including Nigeria's giant Dangote refinery, capable of about 650,000 barrels a day. All right, so let's get started with our market update today. We'll start off with dry van. Load post volumes were within 3% of last year, about the same time as Memorial Day last year, so very similar year-over-year comps. Carrier equipment posts were down about 24% lower than this time last year. Load to truck ratio in dry van up slightly to 5.23 last week. And in the produce market, produce season starting to generate fewer truckloads this season. We're also seeing fewer overall spot market loads. Load posts are down about 4% year over year. But volumes always dip in the produce season at the end of May, so I'm not too alarmed about the negative year-over-year comps with produce. They typically start rising from 5.30 all the way through 7.4. They rise at about the rate of 10% week over week for the next 4 weeks. So we're still on track seasonally for a produce season. Carrier equipment posts down also. Load to truck ratio down to about 6.29. And in flatbed, load posts decreased last week on a short week, but also identical to this time last year. Load to truck ratio is about 9% higher at 19.29. Having a look at a couple of our markets this week, we'll start off with the Midwest. In Chicago, capacity tightened for the fourth week. Rates were up a penny per mile, makes 4 weeks of increases. The outbound average is $1.68. That excludes fuel, so these are line haul rates only. State average Illinois rates at $1.92 are identical to where they were in 2019. A lot of the gains are coming out of the Joliet market, where line haul rates are up 3 cents a mile to $1.71. The big market where Ibrahim is today in Atlanta, there's been a similar month-long trend of tightening capacity. Rates up 2 cents a mile last week to $1.77. That's up 20 cents a mile in the last month. on a 22% lower volume of loads moved. So some capacity tightening there in that big southeast distribution market. And staying in the southeast, it's watermelon season, and unlike last year, there was a shortage of trucks reported in Florida. This year, the USDA is reporting an adequate supply of trucks for northbound loads out of Florida. Peak shipments of watermelons typically occur right before July 4. So far, shipments are up about 14% year over year. Watermelon shipments were the number one commodity hauled last week in the produce market, accounting for about 16% of produce volume. Watermelon production in Florida up 11% year over year. One of the rates that we look at outbound is Lakeland to New York, averaged $2.36 a mile last week. That's 30 cents a mile lower than last year. Loads to Atlanta averaged $2 a mile. That's 12 cents a mile lower than last year, both highlighting the excess capacity in the market on higher volume of production. And in flatbed, capacity tightened in Texas last week. Short shipping week again, volumes were 35% lower in terms of load posts, but outbound rates were up 3 cents a mile to $2.17. Most of the gains in Texas came from the Dallas market, where at $2.02 per mile, outbound rates for outbound loads were 4 cents a mile higher. One of the lanes I watch closely is Dallas to Houston. It's a short regional lane. Rates were the highest in 12 months. Dallas to Houston averaging $518 a load last week. That's compensating for the decline in rates out of Houston. In contrast, Houston to Dallas carriers were paid an average of $650 a load. That's over $100 a load lower than last year. But when you put it together on a round-trip basis, it's still a respectable round-trip average of $2.41, 74 cents a mile higher than the national average. So still some pretty good rates for flatbed carriers in Texas. And wrapping up our market update with our year-over-year look at spot rates, dry van rates up just over a penny per mile to $1.66. Of course, boosted by end-of-month volume last week, sitting about 3 cents a mile lower than last year on an 8% higher volume of loads moved in week 22. DAT's top 50 lanes, based on the volume of loads moved, averaged 201 last week, up 4 cents a mile. And in refrigerated, following a month of elevated line haul rates and shipping volume before key events, including Mother's Day and Memorial Day, spot rates cooled for the second week. Again, they normally do back off a little bit at the end of May before we start the serious produce shipments heading into 7/4. The national average ended last week at $1.97, down just a penny per mile, about 9 cents a mile lower than last year. And lastly, in flatbed, line haul rates remained mostly flat last week, averaging about 207. In fact, they've been flat basically for the last 3 weeks, sitting about 12 cents a mile lower than last year on a 10% higher volume of loads moved. So let's move over to the short-term forecasts. We're starting to see some forecasts now that include the July 4 impact on spot rates. We're starting to see some very interesting movement for those new to our forecasts. The blue line is a rolling 7-day weighted average of historical rates. These are loads moved over 550 miles, excluding fuel, so the line haul only. Ratecast is in green. Red is the short-term model. It heavily weights more recently seen data, and the yellow and grey are blends of the two in varying degrees. So let's start with dry van. The general consensus is that all 4 models will see an improvement in the next 35 days as produce seasonality takes effect. Ratecast in green is reflecting a stronger seasonal trend. It's looking more realistic, I think, given the excess capacity that still exists in the market. The green line is looking for a 4 cent per mile lift through Independence Day, whereas the short-term model is a little bit more optimistic, thinking about a 9 cent per mile lift. I think 4 cent per mile is probably closer to where we'll be. Refrigerated produce season, still a little bit down year over year. I think we'll start to see Ratecast be closer to the money. Again, it's predicting much the same as dry van, about a 4 cent per mile lift. Short term is a little bit more aggressive. It thinks there'll be a 16 cent per mile lift through Independence Day. But again, I think I'm more cautious on refrigerated market given where volumes are at right now. I think the green Ratecast is closer to where we'll be. And lastly, in flatbed, of course, they're all in agreement here. As you can see, it's expecting the cooling in the next month that we typically see. All models are in strong agreement, expecting a 4 cent per mile drop in the next month. It's on the short term. Ratecast is thinking about a 2 cent per mile decrease. Last year, from about this point on until the end of September, September, flatbed line haul rates dropped about 30 cents per mile. In 2018, it was 21 cents a mile. And in 2019, it was 8 cents per mile, but that was a much flatter year from start to finish. So we're at this point where we start to see rates typically cool off between now and the end of September. All right, so with that, I'd like to get to our question of the week and bring Ibrahim back in. Ibrahim, last time we spoke, warehouse vacancy rates were rising, but still not near the long-term average of 6%. How's the market shaping up as we start June?
It's an interesting kind of question. I think the last time we spoke, I mentioned about how demand was easing quite a bit in the industrial sector, and you started to see just like a wave of new supply starting to hit, right? And as a result, if you have demand that's slowing and supply that's increasing, you're going to get rising vacancy. In the first quarter, vacancy actually topped 6% for the first time since 2015 or so. And so we're getting very close to where like long-term average vacancy is in the sector. Again, I think a lot of this is just really supply driven. There was a wave of demand in 2021 and 2022. And as a result, developers really kicked into action and started building more warehouses. And now that demand is starting to slow down, this is when you're starting to see these projects get completed. And so they're kind of getting delivered into an environment where there isn't as much demand as I think developers may have thought.
Right. Is there a difference around in terms of vacancy rates by size of warehouse?
Yes, a pretty significant kind of bifurcation in the industrial commercial real estate sector at the moment. I mean, if you think about like development of these spaces, there really isn't a whole lot of like developable land in areas close to city centers, which is where you typically find like smaller industrial buildings. And so when developers look to develop, they're usually looking further out from city centers on the outskirts of towns or in areas that don't necessarily have large populations. And when they do, they typically build larger buildings. And so most of the supply that's been delivered over the past several years has been focused on these big 250,000, 500,000 or a million plus square foot warehouses. Smaller buildings that are like 150,000 square feet or below, there hasn't been a lot of new development activity. Again, a lot of these warehouses are really located closer to city centers where you can't really develop more. And so the vacancy rate is quite a bit different. If you were to look at vacancy rates of like buildings that were 250,000 square feet or above, it's close to double digits now. And before this year is over, it's likely to be over double digit vacancy in those spaces. But smaller spaces, I think you're still looking at vacancy rates that are still quite low.
Very interesting. I was looking at some of the industrial production and residential and non-residential construction spending data from the Fred database last week. It's kind of interesting. Non-residential construction has slowed somewhat. It's down slightly month over month. But the interesting data point, when you look at the shape of the charts, we've seen, to your point about some of the massive growth we've seen since the October 2021 inflection point, where we started to spend a lot more on non-res construction. Total construction spend is up 40% since that point in time. But since May 2022, when the residential market started to cool, spending has dropped about 8%. So again, you see this bifurcation in spending non-residential versus commercial. And we had this pretty steep increase in spending all the way through to the end of last year. But for the last few months, it started to cool down. I mean, it's not dropping dramatically, and it's still way above where it would be longer term. Do you think that's reflecting, spending is reflecting some of those vacancy rate questions that you're asking?
Sure. I would say that there's sort of two components to this kind of non-residential construction that's going on. So there's the warehousing construction, which is the stuff that I look at quite a bit. But there's also been a significant uptick in just like spending on constructing manufacturing plants. Like if you pay attention to just kind of like the political landscape and some of the recent legislation, there's been quite a bit of legislation passed over the past couple of years to incentivize just bringing manufacturing back to the United States, particularly for things like renewable energy, for things like semiconductor manufacturing. There are significant tax incentives for that. And as a result, you saw like just a bunch of companies announce plans for electric vehicle production or battery production,
Right.
solar panel production. And all of these are just like manufacturing plants that have to be built. And so there's a significant uptick in just like that kind of spending. It hasn't quite translated to actual manufacturing activity yet. If you're thinking about like from a freight or warehousing demand standpoint, usually takes a little while before these manufacturing plants get built and are up and running.
Right.
But it does have some kind of positive implications when you're looking towards the future. I think by the time you get looking like 2025 or and beyond, there should be some of these manufacturing plants that are coming online, which should drive a significant amount of activity.
Right. In terms of, where brokers might be looking for shippers and carriers looking for freight, are there any particular markets that stand out to you in terms of either growth or increasing vacancy rates?
Well, in terms of just like activity, I've been a big fan of just sort of like cross-border between U.S. and Mexico trade, and so both on the warehousing side and on the trucking side, I think there's just a significant amount of production that's moved into Mexico. As a result, there's just noticeable increases in like the demand for warehouses on both sides of the U.S.-Mexico border. So if you think about towns like El Paso in Texas or Monterrey in Mexico, right, these areas benefit quite a bit. Those kind of movements, I think, are poised to grow significantly over the next couple of quarters. But again, going back to this idea of just like reshoring production, I like some of these to focus on some of these areas where these manufacturing plants are being built currently, because again, I mean, they may not be up and running yet, but they are likely to be up and running over the next, by the time you get to like the beginning of next year and going forward. Right. So I mean, if you think about like the Southeast, where a lot of these manufacturing plants are taking place. Areas in the Midwest, some of the old sort of traditional industrial markets, like Detroit, things like that. There's been renewed interest in just like construction, manufacturing activity, relocating there. Phoenix is another one that I think has those kind of positive long-term implications. But currently, I like the cross-border kind of activity. I think that's a real area of strength in an otherwise fairly flat kind of market.
That's interesting. Yeah, we're certainly seeing some of that increased activity in our business, especially in the spot market along that border. Any thoughts on the Inland Empire, Ontario market, where I've read about sort of escalating vacancy rates and some pretty sweet deals to entice people into those vacant spots?
Well, yes. Inland Empire, it's an interesting kind of case study as to like how the industrial sector has responded during the pandemic. I mean, there was a flood of activity for tenants to try and locate in that Southern California region as they try to bring in imports from Asia. And as a result, like Inland Empire vacancy got below 2% at its lowest. I mean, you're looking at essentially vacancy rates that were around 1.25%. And anytime you have vacancy that's that low, essentially what you're saying is like any kind of functional building that's up and running is being occupied. Right. And as we kind of normalized away from the pandemic, you see that kind of normalization play out in the Inland Empire as well. That some of the space that was being occupied because of the pandemic is now being consolidated or being left. There was also a wave of construction in the Inland Empire in 2021 and 2022 that's now being delivered, which is making the vacancy problem worse. But essentially, you've seen vacancy go from, again, under 2% to close to 7% in the span of about a year and a half in that area. And so just a significant movement in vacancy rates there. Now, when that happens, again, depending on the size range that you're talking about or the location within the Inland Empire, you may find owners that have space that they can't fill. And when that happens, you start to see more incentives to try and fill the space up. And so I think that kind of thing is likely to continue at least until the supply risk is kind of exhausted. There's still a decent amount of space that still has yet to be delivered. Right. But once that kind of supply risk passes, I think you'll start to see things normalize a bit more in that area.
Right. I'd like to switch gears a little bit to macroeconomics, your area of expertise. One of the questions I had this week that came in from Justin Danks at Sunset Transportation. It was a really good question about the impact of interest rates on the general economy. Could you sort of give us a sense about how you think about interest rates, where they're headed, and what implications that might have on the freight market, including things like residential construction around single-family homes?
Sure. So I think I'll take the latter part of it, is understanding like the dynamics and how it plays out in the freight market first.
Okay.
Where it's headed, I think, is a tricky kind of game. I'll give my best guess, but no promises there.
Okay.
But typically, when you think about like what the Federal Reserve tries to do when they raise interest rates, essentially they want to raise the borrowing costs for people that are looking to borrow money. That has implications for the demand for anything that requires borrowing. And so if you think about like the kinds of purchases that require borrowing, you're looking at durable goods, automobiles, home sales, right? Like these are the markets that get hit the hardest by increases in interest rates. Now the bad news is like a lot of those durable goods is what drives trucking demand, and it also drives warehousing demand in the macroeconomy,
Mm-hmm.
right? So like when you think about the sectors that get hit hardest by interest rates, they're usually the things that feed into the transportation and logistics industry. Mm-hmm. So again, like appliances, automobiles, home purchases, and things of that nature, all get affected by rising interest rates. Mm-hmm. And it's one of the reasons why like the elevated interest rates that we've seen over the past couple of years have had sort of like an outsized effect on our industries. Right. Whereas like the broader economy, there are other areas of the economy that can sort of shrug an increase in interest rates off. If you look at non-durable goods or services, which typically don't need to be financed, an increase in interest rates, it may slow activity some, but it's not enough to just like slow it enough to slow the broader macroeconomy down. As to where it's headed, a lot of it hinges on just the ability to get inflation under control. If you think about where inflation has been trending, it essentially peaked several quarters ago, and it's been on a downward trend since then. It just hasn't come down as fast as I think policymakers might have thought or forecasters might have thought. And as a result, interest rates have just stayed higher, like long-term interest rates have stayed higher for longer. Mm-hmm. I still think that inflation is largely under control. It's a difficult kind of problem that the Federal Reserve has, and that they're trying to balance reducing inflation without pushing the economy into an overall recession, which is a difficult kind of task. I think as you go on, you'll start to see longer term interest rates begin to drift down closer and closer to 4%. Right. But again, it largely hinges on the ability to get inflation under control. Like if you keep getting positive surprises on the inflation front, or if inflation proves to be more stubborn than we think, then 10-year interest rates or longer term interest rates are going to be higher than what you might expect. If for some reason the economy slows down more than what's expected, or you start to see inflation decline a lot faster than expected, then you'll actually start to see the 10-year rate come down quite a bit faster. I think like a good neutral kind of rate for the 10-year rate is around 4%, like somewhere between 3.25% and 4%. And so to the extent that we're still above that, it's a reflection of just how stubborn inflation has been and how strong the economy's been in the face of these interest rate increases. But yeah, I think over the long term, you'll start to see a drift somewhere between 3.25% and 4%, and that's kind of where you'll sit.
Right. Is that in terms of where interest rates are going, and for those in the freight market, what would be some key indicators people should be watching from a freight perspective? Like what would be the early warning signals or early indicating signals that the market's improving on a freight perspective?
So early indications for freight market improvement, I like some of the survey. So just to back up a little bit, I think a lot of the weakness in sort of freight demand currently is being driven by just like overall softness in the manufacturing sector. Like if you look at manufacturing production, or if you look at survey data on manufacturing, it really hasn't grown over the past year and a half or to 2 years. Like we've been in sort of a manufacturing funk during this time period. And so you look for some indications that that's beginning to turn around. I like to look at like the Institute of Supply Management, their new orders and new export orders data. There's durable goods orders that come out of the Census Bureau that gets released every month, which kind of gives you a forward look to say like this is where orders are trending.
Mm-hmm.
Other indicators that I think are important for trucking demand is just housing activity. Like I think it's important to see like how residential housing construction looks.
Right.
Import and export data I think drives a lot of a good amount of trucking demand also.
Mm-hmm.
And then of course just consumer spending on goods. And so like if you kind of think of it in four buckets, like international trade, manufacturing, housing activity, and consumer spending, like those are the things that are going to drive your trucking activity. And right now, only one of those is doing particularly is doing well, which is just like consumer spending on goods. Like consumers are still buying a decent amount of things, but most of the other areas are kind of showing some signs of weakness. So I look to that on the demand side.
The ISM PMI, I think, came out this week. It came out at 48.7%.
Yep.
So the sector contracted in May for the second consecutive month and the 18th time in the last 19 months. So after a little bit of upward movement, it's kind of come back down into contraction territory. Is that sort of, symptomatic of just how weak the underlying economy is overall?
Well, at least from a trucking demand standpoint, yes, right. I mean, and I hesitate to call it just like terribly weak. I mean, the numbers have been in contractionary territory, but they haven't been terrible. Right. Like they've been sort of like slightly below 50, which is the sort of threshold between expansion and contraction. Yeah. And so these kind of readings of 48, 49 and a half, 48.4, like these are the kind of readings that we've basically seen for the last 2 years. And when we did get a positive reading, it was only 50.4. Like, I mean, and so you're kind of hovering in this just kind of, it's not awful, but it's just not growing. Right. And it's just kind of hovering in essentially flat. And that's how I view just sort of, it's how I view tonnage on the trucking side. Like, it's not awful. It's just kind of not growing anymore. And it's certainly not enough to kind of fill all the capacity that's out there. And it's a similar sort of thing on the warehousing side, that, you look at the demand drivers for warehousing, and outside of like e-commerce, which I think is still growing at a decent clip, you look and you just say, oh, the rest of this is just kind of flat. It's not awful. It's not like what you would see during a recession, but it certainly isn't growing anymore. And it's weighed quite a bit on the sector.
All right. So last question, I think worth talking about is loan defaults. John Kingston had a great article out in FreightWaves about BMO write-offs and some of their credit issues. They're a large lender of truckload finance. Any thoughts on where we are with credit defaults?
Well, in the commercial real estate side of things, I think loan defaults are a big problem on the office side, and to in some areas of retail, not necessarily on like the warehousing side. So if you think about like what would make a loan default for commercial real estate, it's essentially like you have like a floating rate loan that's out there that you need to refinance, and all of a sudden you can't find anybody that's willing to refinance it.
Right.
The problem that the office sector has is like the property values for office have declined significantly, and they've been declining for the most part since the pandemic. And so these people that took out loans in 2019, 2018 that now have to refinance. They now have to do it with a property that's worth a lot less than what they originally signed on for. Nobody's willing to sign on for, like a lender isn't really willing to sign on for that. For industrial, it's actually fairly easy to refinance, or at least comparably easy to refinance, because the value of industrial properties rose significantly during the pandemic. Like in 2021, 2022, industrial values rose 40 to 50%. And so even if there's some weakness currently, you might see in your experiencing just like rising vacancies in the sector. If you have an industrial property that you purchased in 2019, the odds are the value of that property is significantly higher than when you first went into it. And so when you go to refinance, it's usually you can find some lender that's willing to sign off on it. And so when you look at like delinquency data, there's a surge in delinquencies on the office side. Retail had a problem early in the pandemic and is still pretty elevated. But if you look at, say, like apartments and industrial properties, the delinquency rate, I think, is still pretty low. Right. Again, because of the rise in values that took place in 2021 and 2022.
Got it. All right. Well, hey, that brings us to the end of the show, Ibrahim. A couple of shout outs before we wrap up today. Ken Adamo is at the Future of Freight, the Freightways event in Atlanta today. He'll be on a panel with Zach Strickland. It's the great debate, DAT versus Sonar. Where is the market headed? You can catch that live. Just go to events@freightwaves.com. On the latest Freightvine podcast, Chris Kaplan is talking to David Landau. He's talking about the supply chain software industry and how much that's changed. On our show next week, David Hoffman joins us, one of our shippers from Paratus. They're a baker in the food industry, so we'll be talking about some of the trends in the shipping industry for food. Of course, this weekend we have the TSMA Elevate conference in New Orleans. They're celebrating their 100-year anniversary. I'll be there with Lee Klaskow from Bloomberg talking on Tuesday, I think, is our panel. Don't forget the ATHS Historical Truck Society show is on in York, PA. I'll be there with my truck, catching up with Dave Nemo from Radio Nemo and Chuck Snow. Ibrahim, lastly, how can people contact you if they've got some questions?
I mean, the easiest way to contact me these days is through LinkedIn. And so, if you can just look up my name on LinkedIn, reach out if you want to connect. And if you have any kind of questions, I'm typically pretty responsive.
Yep.
So that's the easiest way. Yes.
And of course, anybody can contact us at DAT. Just write to askiq@dat.com and we can put you in contact with Ibrahim. Don't forget the long form version of today's market update will be published this evening. Go to dat.com/market update. And with that, another show is in the books. Be safe, everyone, and we'll see you next week at 10 a.m. Eastern, 7 a.m. Pacific.